Welcome back to Investing Talk podcast.
Today we're looking at CVS Health. The big question is it a good time to buy now?
We want to hear from you. Subscribe, like, and comment to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. We took a pretty thorough look at the source material here, and we landed on a robust overall bullish rating. We're talking 8.5 out of 10.
8.5, that's pretty high. What's driving that confidence?
Yeah, it's high. And it's really driven not just by, market feeling, but by some really verifiable fundamental strength and, well, some clear positive momentum, we're saying.
Okay, so foundational strength. Let's start there. I saw the Q3 2025 revenues hit a record, right?
Yeah.
$102.9 billion.
Exactly, a record high. And that's a very healthy 7.8% jump year over year.
Almost 8%. But, where did that growth actually come from? Was it just more people buying toothpaste?
Well, no, not quite. It wasn't just the retail side carrying all that weight. That 7.8% growth was heavily weighted towards two key areas. Pharmacy services, that's their Caremark PBM, and the healthcare benefits segment, which is Aetna.
Ah, okay. The PBM and insurance arms.
Right. They're seeing strong contract renewals there, and importantly, pretty stable medical cost ratios. That lets them capture growth pretty effectively.
And profitability. Because revenue is one thing, but making money is another. I saw something about adjusted operating income.
Yeah, that's where it gets really interesting. Even when you account for some of the, let's call it financial noise, those one-time items we'll touch on, the actual operational performance looks sharp. Adjusted operating income jumped 36%.
36%, wow.
Yeah, up to $3.459 billion.
Yeah.
That kind of surge, even adjusted, signals that the core engine, especially that whole vertically integrated machine they've built, is running efficiently. It's disciplined.
And that integration is the competitive advantage, isn't it? The moat.
It absolutely is. You can't just chalk it up to brand recognition. What makes CVS so dominant, really, is owning the whole chain. Aetna for insurance, Caremark for managing prescriptions, and then the stores for delivery.
Right, they control it end to end.
Exactly. That structure gives them cost controls and ways to integrate services that are just, well, very hard for competitors to replicate. It's a powerful, sustainable advantage.
Okay, so strong operations, strong moat. What about the balance sheet? Financial health overall? I know they took on a lot of debt with Aetna a few years back.
That's true. The debt load is significant, and it's definitely something to watch. It's a leftover from that huge Aetna deal. But the sources we looked at point to a currently robust balance sheet and, crucially, strong free cash flow.
So the cash flow helps manage the debt risk.
That's the key balancing act. That strong free cash flow is absolutely essential. It lets them handle the legacy debt while also funding innovation, the digital health, investing in growth, and, importantly for investors, giving up dividend payments and share buybacks.
That return of capital is a good sign. Suggests management feels pretty confident about future cash generation, even with the debt.
Precisely. It shows they believe the engine is strong enough to handle its obligations and reward shareholders.
Okay, let's shift gears a bit. Recent news and the Q3 results. Because, like you said, there was some noise there. The headlines felt a bit mixed, even with the strong revenue.
They were. Let's start with the expansion. In October, they closed that big deal to acquire Rite Aid assets. That significantly expands their pharmacy network footprint.
So more stores, bigger reach, that seems straightforwardly positive.
On the surface, yes. Huge expansion. But integrating it is a massive task. And that brings us to the other big piece of Q3 news. While the overall revenue did beat forecasts, the top line looked great, the report also contained a pretty substantial charge.
A charge? What for? This hit the earnings per share, right?
It did. It significantly impacted the reported EPS number. And this charge was specifically tied to their clinic business, which has been, well, struggling a bit.
Okay, we need to unpack that. What exactly is this clinic business? Minute Clinic?
Yes, primarily Minute Clinic and also the newer kind of expanded health hub formats they've been rolling out. The charge was mostly a goodwill impairment.
Goodwill impairment. So basically writing down the value of something they previously thought was worth more.
Exactly. Plus some restructuring costs. They're optimizing the older Minute Clinic locations and pushing harder towards that more integrated, digitally connected health hub model. Management is essentially saying, okay, we overvalued some older stuff and we're cleaning house now to focus on the future model.
Got it. So the hit to earnings wasn't from the core PBM or Aetna failing. It was a non-recurring accounting thing tied to fixing the clinic strategy.
That's the crucial distinction. It's an expensive pivot, yes, But it's about fixing those clinic challenges while also dealing with the massive complexity of bringing those Rite Aid assets into the fold.
That sounds like a lot to juggle. Integrating thousands of stores, IT systems, staff, while restructuring another part of the business.
It is. It's a dual focus.
Mm.
Optimize existing assets and execute a huge M&A integration. And yeah, the market definitely wants to see that management isn't spreading itself too thin here.
Which makes the stock's performance even more interesting, because technically it seems to be handling this okay.
It does. Let's look at the technical picture. The price action shows a pretty clear, sustained bullish trend. You're seeing those higher highs and higher lows consistently. That suggests investors still have confidence in the longer-term story, despite these operational hurdles.
And it's staying above key moving averages, I assume?
Yep, that's the confirmation. The stock isn't just drifting. It's consistently trading well above both its 50-day and 200-day moving averages. Those are around $75,072 right now, roughly. Staying above the 50-day, especially after any dip, often signals that institutions are stepping in to buy.
Okay, so near term, what are the momentum indicators like? RSI, MED, are we looking overbought or is there room to run?
Good question. Right now, the RSI is kind of hovering in the mid-50s to low 60s range. That's actually pretty healthy, meaning it shows solid bullish momentum, but it's not screaming overbought. There's still potentially fuel in the tank for more upward movement without necessarily needing a sharp pullback right away.
And key price levels, where's the resistance we need to break through?
We're seeing key resistance starting in the low $80, I think around $82, and then a bit stronger near $85. Getting through those levels cleanly is what you need to see for a run towards that, say, $90 target area in the next few months.
So support around $78, resistance maybe $82 to $85, potential towards $90 in the short term.
That's a reasonable trading view for the next, say, 3 months based on the current setup.
And this technical strength isn't happening in a vacuum, right? What are analysts saying?
No, it's backed up externally. We've seen analysts steadily upgrading the stock, raising their price targets. The average target is now up around $87.50.
Okay.
Some of the more bullish analysts are looking up towards $103. Plus, data shows increased institutional inflows lately. Big money seems to be positioning for maybe a break above that $85 resistance.
Interesting. So the institutions seem to be betting on the positive catalysts outweighing the integration risks.
It looks that way, and that institutional positioning often lines up with upcoming events. We should probably talk about the catalysts expected over the next 3 to 12 months.
Yeah, what should people be watching for beyond just the next earnings report?
Well, the Q4 earnings release in January is obviously huge. That's where they really need to show the Rite Aid integration is on track and that they're getting a handle on fixing the clinic business costs.
Right. That's the proof point.
Definitely. But even sooner, you've got the November Q3 earnings review call where management will give more color. And then there are market mechanics.
Like what?
ETF rebalancing. That happens often in November and December. CVS Health is a big holding in healthcare ETFs and broad indices like the S&P 500.
Ah, so passive funds might have to buy more shares just based on weighting changes?
Exactly. If its weighting increases due to performance or index rules, those passive funds become non-discretionary buyers.
Right.
That creates steady demand. Also, watch for the institutional investment updates in December, seeing if major pension funds or endowments added to their positions in Q3.
Okay, those are the more predictable near-term things. What about longer-term drivers? Any buzz or speculation out there?
There's always buzz. A lot of it centers on potential strategic partnerships, especially with tech companies. Think about boosting their digital health offerings, maybe remote patient monitoring, things that could help Aetna control costs long-term.
That makes sense. Using tech to make the integrated model even more efficient.
Right. And then you hear the usual sort of background noise about potential M&A, maybe buying something to strengthen their specialty pharmacy services, or perhaps expanding geographically.
Are those rumors credible or just market chatter?
Hard to say definitively. They're mostly unsubstantiated right now. But the fact that the market even entertains these possibilities suggests confidence that management could execute if the right opportunity came along. It reflects positively on their perceived capability and balance sheet flexibility.
But there's always a flip side. What about the risks, particularly regulatory ones?
Yeah, you absolutely have to keep the regulatory environment in focus. There's ongoing speculation, especially heading into an election year, about potential changes targeting PBMs. That's their Caremark business.
So the very thing that gives them their moat, that vertical integration, could also be their biggest regulatory headache.
That's the potential conflict, yes.
Wow.
It's a significant risk factor to monitor.
Okay, so let's tie this back to the overall risk picture and the investment thesis. What are the main hurdles CVS needs to clear?
The primary risks are really operational right now. First, successfully integrating Rite Aid. That means hitting synergy targets, managing costs, unifying systems, all that complex stuff. Second, delivering on the fix for the clinic business, proving that impairment charge wasn't just writing off value, but part of a real turnaround plan. Q4 results will be critical for showing progress on both fronts.
So it's less about the market itself and more about CVS executing on its own plans and navigating potential regulation.
I think that's fair. Broader market volatility is always a factor, of course. But CVS has actually shown pretty good resilience compared to some peers lately. Management seems focused. The market seems to believe these internal risks are manageable if they deliver in the upcoming quarters.
Okay, so pulling it all together, the final thesis for someone considering CVS Health now.
Well, you've got that strong foundation, record revenue, good adjusted income growth. You have the powerful competitive moat from integration. You have clear technical momentum backing it up. It all supports that 8.5 bullish rating.
Driven by catalysts both short and long term.
Exactly. You have near-term catalysts like the ETF rebalancing and the crucial Q4 earnings report, and you have the longer-term potential from leveraging their integrated model, potential partnerships, maybe M&A down the line.
So it could appeal to different types of investors?
I think so. It looks potentially attractive for shorter-term traders playing those upcoming catalysts in the next quarter or so, but it also fits a long-term investment case based on capturing that structural growth within the evolving U.S. healthcare system.
It's a compelling story, definitely growth, integration, efficiency. But that regulatory shadow over the PBM seems like the big unknown hanging out there. Can that incredibly profitable model withstand the political winds that might blow against it? That feels like the key long-term question mark beyond the immediate integration challenges.